This is the biggest corporate fraud in history of the U.S., erasing $74 billion in shareholder value and eliminating over 20,000 jobs. Once its stock price peaked at $90 per share, the company earned accolades as America's most innovative company by Fortune magazine for 6 consecutive years. This is the story of Enron, a well-established industry giant to $64 billion bankruptcy. The Enron scandal exposed systemic corporate misconduct, triggering widespread outrage and promoting transformative reforms in financial regulation. But how did one of the most celebrated companies in America become its biggest corporate fraud? In this video, we are going to explain the rise and fall of Enron, the mastermind behind the Enron scandal, how this scandal conducts, and finally, what you can learn from this disaster. Before we dive in, comment below. Which scandal shocked you the most? And hit subscribe if you're into true corporate crime stories. In 1985, Kenneth Lay formed Enron by merging Houston Natural Gas and Internorth. By 1986, the company was renamed Enron. In the early 1990s, Lay pushed for deregulated electricity and natural gas markets, allowing Enron to sell energy at higher prices, boosting revenue. Despite calls for regulation due to price volatility, Enron's lobbying efforts prevented it. With Jeffrey Skilling's help, Enron shifted from a gas supplier to a trader of energy derivative contracts, becoming North America's largest natural gas seller by 1992, with trading profits of $122 million. The 1999 launch of Enron Online enhanced its trading efficiency. Enron diversified into assets like gas pipelines, electricity, water, and broadband globally, while trading related contracts. It built power plants in developing countries like the Philippines, Indonesia, and India. Fueled by the 1990s bull market, Enron's stock rose 311% from 1990 to 1998, then surged 56% in 1999 and 87% in 2000, reaching a $60 billion market cap by December 2000. Enron's rise in the 1990s was rapid. By leveraging deregulated energy markets and innovative financial strategies, the company achieved extraordinary growth. Its adoption of mark-to-market. Under the leadership of Kenneth Lay, Jeffrey Skilling, and Chief Financial Officer Andrew Fastow, Enron created an image of invincibility. Fastow developed complex financial structures, including special purpose entities, to manage debt and enhance reported earnings. These entities, such as the LJM partnerships, were used to transfer assets and liabilities off Enron's balance sheet, creating the illusion of financial health. Enron's success attracted widespread admiration. Wall Street analysts praised its innovation, and its stock price soared, making it a darling of investors. Employees, many of whom held Enron stock in their retirement plans, believed in the company's long-term prospects. However, the reliance on special purpose entities, or SPEs, and aggressive accounting practices introduced significant risks, setting the stage for a catastrophic collapse. In September 2000, a Wall Street Journal article on mark-to-market accounting's lack of transparency led short seller Jim Chanos to review Enron's 10-K, spotting issues with its broadband unit, high capital spending, and insider stock sales, prompting him to short Enron stock in November. In March 2001, Bethany McLean's Fortune article questioned Enron's high stock valuation, citing unclear financials and rising debt. After Chanos's tip, CEO Jeffrey Skilling dismissed her inquiries as unethical, and CFO Andrew Fastow refused to disclose earnings details. In April, Skilling insulted analyst Richard Grubman, for questioning Enron's opaque accounting. In October 2001, Enron reported a $613 million quarterly loss and disclosed accounting errors that reduced shareholder equity by $1.2 billion. As Enron's financial troubles became public, its stock price plummeted, falling from $90.75 in August 2000 to less than $1 by November 2001. On December 2, 2001, Enron filed for Chapter 11 bankruptcy, with shares trading at 26 cents.
Enron Corp. filed for what at the time was the largest ever corporate bankruptcy. Now, it was a filing that came with a warning that a substantial number of Enron's 21,000 employees would be out of a job as the company's market value plummeted amid multiple investigations into allegations of accounting fraud.
So, how did they do it? The Enron scandal was enabled by a combination of fraudulent accounting practices, lax oversight, and a culture that prioritized profits over ethics. Andrew Fastow created hundreds of special purpose entities, or SPEs, to hide Enron's debt and inflate its financial performance. These entities were off-balance sheet vehicles that allowed Enron to transfer assets and liabilities, masking its true financial condition. Enron's use of mark-to-market accounting enabled it to record estimated future profits as current earnings. Suppose you set a $1 million possibility of earning from a business, and before earning that amount, you add that to your business spreadsheet. It's called mark-to-market. This practice misled investors and analysts about the company's financial health, contributing to its inflated stock price. What can we learn from this fraud? The Enron scandal provides lasting lessons for various stakeholders, emphasizing the need for transparency, accountability, and ethical leadership. Investors must carefully examine financial statements, demand independent audits, and diversify portfolios to avoid risks like Enron's hidden debts and inflated earnings. Employees should avoid over-concentration in company stock for retirement, advocating instead for transparent and diversified plans to safeguard their financial future. The Enron fraud remains a defining moment in corporate history, symbolizing the dangers of unchecked greed and lax oversight. It inspired numerous documentaries such as Enron, The Smartest Guys in the Room, 2005, and continues to be studied in business ethics courses. The Sarbanes-Oxley Act and subsequent reforms have strengthened corporate governance, though debates persist over their costs and effectiveness. The scandal's global impact, from Houston's economic devastation to international regulatory changes, underscores its lasting significance. As a cautionary tale, Enron serves as a reminder of the need for vigilance, transparency, and integrity in corporate practices. If you find this story helpful, please like, share, and subscribe, and do not forget to turn on the bell icon.